Well, good evening, everyone. Welcome back to the channel. So we are going to do a reaction to an interview that Jay Pestrichelli of YieldMax just did on another channel, and so we will hop to that in just a second here. But before we get to that, I just want to give everybody a chance to see if anybody has any questions or anything up front that they wanted to chat, because I'm not going to look at the chats again until the end of this video. So if not, we will, within the next 30 seconds or so, we will dive right in to the Jay interview. They covered a lot of topics. They covered the new YMAX fund. They covered diversifying, so on and so forth. So yeah, all in all, it looks like a pretty good interview. It went for like 50 minutes. We won't react to the whole thing, but we'll try to hit the key points. So, all right. Let's hop to it. Hope everybody's had a great weekend. It's almost concluded, and what a way to cap it off, right? What better way could you think of to cap it off than to join the coach here for a live reaction? Okay, let's see. Here we go. So the channel is called Passive Income Investing. And he actually referenced the last interview that Jay did on this channel. He mentioned he was going to link it, but I don't think he's done that yet. So definitely we'll try to, send a reminder if we have to. I'm not in direct contact with this channel, but just like him to link that since he mentioned it. Anyway, so yeah, here's the channel. It's a huge channel. Definitely recommend checking it out. And here is the first thing that they said.
We've all been waiting for. So I saw on your website, and I was going to ask you this question, but we already know it's an equal weight strategy. So can you tell me what is the rebalancing plan or the strategy behind that? When, let's say, a new fund comes in, are you going to rebalance right away? Are you rebalancing every month? How is that going to work exactly with the whole rebalancing concept, keeping it?
Yeah, great.
So I'm running this on 1.5x, so it might sound a little faster.
Yeah, great question. And you're right. It's funny that you say we've been waiting for. Believe it or not, the premise.
I'm actually going to slow it down a little bit because he does talk fast as it is. We'll do 1.25. So rebalancing.
Behind us launching this fund was because our investors had asked for, like, hey, can you just package one up? Like, I'm tired of doing the rebalance myself, or you've got 18 of these things out there now. So yeah, no, this is actually an investor requested fund. So we were happy to put it out. And you're right, equal weighted across the existing 18 YieldMax single.
So YMAX is a fund he was talking about for like 6 months. I think it was the #1 in-demand fund.
Name ETFs that we have today. They, you can do the math on the percentage there, right? I think it's like 5.6% something. And so the rebalance will occur as we launch new. Well, let's say first thing, we will rebalance monthly, right? So those ETFs are going to have their ebbs and flows naturally. So just rebalance back each month, just bring every position back to kind of its that target 5+%. So now let's say we have a new ETF that's launched. Let's just say we launch one on, I don't know, GDX, right, or Zoom. If one of those are out there, we're going to wait until they pay their first dividend, and then on the next rebalance, we'll bring them in. So there could be, in theory, I think we've seen times where we went live with an ETF, waited 6 weeks for the first dividend because maybe it was in the latter half of a month. We get a full month of dividends, we get a month and a half, and then whenever the next monthly rebalances. So I guess in theory, we could go as long as 9 weeks, but probably, my gut tells me it's probably more in the range of 7 weeks before it finds its way into the YMAX fund of funds.
Okay, so
that's very interesting, that point. So he said 7 weeks.
It's not going to be right away when a new one comes in. You're going to wait a little bit and then put it in. So yeah, monthly rebalancing, that's pretty often, more often.
Yeah, monthly rebalancing. A reminder, this is about when new funds come in.
Often than you would, than I usually see, which is semi-annual or quarterly. And that brings me to right away the management fee. You guys are actually adding a little management fee on top, 29 basis.
This is a great point, a 29 basis point increase in the management fee. So pay attention here.
Points on the YMAX. So obviously it's 99 plus 29. 99 is because the underlying have 29. So total YMAX MER is 1.28. And now I see why, because if you're rebalancing monthly and there's more work to be done, obviously you should be compensated for that. But typically when it's a fund of funds, there is no extra management fee. So what would you say to that? Or people who complain, hey, there's an extra 29. Why are they doing that?
Yeah, so it's obviously an important question. Fees matter. We understand that for sure. So you're right. The first thing is the active management of the rebalancing, monthly instead of quarterly. I will say that there are some fees necessary to put out a fund, right? Exchange fees, auditing fees, accounting fees, all of those things in there. But the main thing that I think about where the extra added value is, realize this: there are times where we will want to harvest taxable gains or taxable losses for tax credits. So let's say, for example,
this is an interesting point.
The fund has an ETF and it goes down 25%. Well, you want to kind of take advantage from a tax perspective and close that out. But since you want to avoid the wash sale rule, which is kind of the reason that stops everybody from selling, taking the tax loss, and then rebuying, we, as the managers of the fund, can then actually replicate the option build of that YMAX individual ticker within YMAX itself. So you take, let's say we were to do it with, I don't know, pick another AI, right? So AI is down 25%.
I thought he would mention Tesla.
Close the AI ETF, and then we replicate it for at least 30 days with the normal synthetic build right in the YMAX fund. And so it's not so much, sorry about that, it's not so much that it's the rebalance that takes more time. It's actually then replicating the strategy within the YMAX fund to fund itself.
Right.
So in other words, at times it won't be just the fund to fund. Sometimes it'll actually hold the option positions of the underlying YieldMax single stock ETF.
Okay, but when you say close out the ETF, it's not like you're kicking out an ETF from YMAX or anything like that. You're doing just to harvest tax benefits, right? And I'm assuming Rock is going to come with that. There's a whole, we could probably do a whole other video on Rock and how there's so many.
These are good questions that have been coming up a lot on my live stream. So it's interesting. So the added value is some extra tax harvesting that it sounds like they're doing. So that's an interesting point.
Misconceptions about it. People think it's just my own capital coming back to me. I've done a few videos on this. It's a load of baloney. You have to understand that Rock is just a tax classification. Maybe you could speak about this.
Listen up, people, on this, because we've been talking a lot about return on capital on this one.
I know it's probably a common question or concern you get, because I'm assuming, like the Tesla, for example, or the ones that have gone down, you're going to see a lot of Rock. Can you explain how Rock is not just your own money coming back to you?
Yeah. And so for those that don't know, Rock is short for return of capital, right? And it's a classification that a dividend can carry. So first off, I'm not a tax expert, and I will give you all the disclosures there that I'm not the one that makes those determinations. But here's how it happens. By the way, very common in any options-based ETF. This is not just unique to YieldMax. This is very common across the board. So what happens is, let's think about the goal of YieldMax, right? Of any of the YieldMaxes. It's income, right? It's selling options for option premium to be distributed in the form of a dividend. So our goal, whether the underlying makes money or doesn't make money, is to return the income we make from selling those weekly calls. I know by this point, everybody on your channel knows we're selling weekly calls on underlying tickers. Yeah. Well, sometimes the underlying stock could go down, and the synthetic portion that represents the movement of the stock could realize a loss, right? We have options, we have to trade, we have to rotate those options and roll those on the synthetic side. Sometimes those realize a loss. And so let's take, for example, let's say a stock is down 6%, and we meanwhile sold calls during the month for 2%. I'm just picking out of the air. We're net minus 4%, right? The fund for that month is minus 4%, but we're still going to distribute the 2% yield we made from selling the calls, because that's our obligation to generate the yield. It's in the perspectives. It's our primary investment objective. But the stock lost, right? The ETF itself lost money. So that's what happens is, hey, even though you have a net realized loss of 4%, when we distribute that 2%, that gets categorized as return of capital, because the total of all the trades was a net loss. That's how it works.
Yeah.
And actually, there's a little benefit, right? I mean,
it is. And I've done a lot of research on this. I read many articles on this. What it ends up being is, I know you said you're not a tax expert. I'm not a tax expert either. But in Canada, for example, the option premiums, it's all capital gains. It's all capital gains. So if the ETF itself has a loss, either on your side, you guys do it synthetically. And in case my audience doesn't know what we're talking about when you say synthetically, in the YieldMax and even the Defiance, you don't hold the Tesla stock or the Google stock. You're not holding the actual stock. You're owning it synthetically. That's where the synthetic comes in by having a long call and a long put, I believe, or short put.
These don't actually hold the stocks. Obviously, these hold the synthetic positions.
A long call, long put, I believe, right?
Long call, short put. You got it.
I always get confused by that.
That's okay.
You're the expert. So you're holding it synthetically to track the price movement of the stock. So although you're not holding the stock, you're basically doing options to track its price. But anyway, like I was saying, back in Canada, I mean, if the ETF is at a loss, you could offset those losses with those option premiums. And then instead of having it as capital gains, you have it as Rock. It's not necessarily a bad thing. It's just the option premiums looking like return of capital.
One thing I wanted to point out, because I know this has come up on other channels, but this guy just did a video talking about why he was selling YieldMax. So for any people, watching other channels, take that into consideration, because I thought that was interesting. I have never actually sold any YieldMax or done a video on why I'm selling YieldMax. But I just wanted to throw that out there.
Instead of capital gains, but return to capital is better because it's not taxable. So thanks for answering that. It backs up exactly what I've said in previous videos. And I hate talking about taxes. I don't want to spend too much time on that, but thanks for answering the question.
You're welcome. But it is a topic that comes up from time to time.
I'm sure.
You're right. There's, it's worth addressing how it can even happen. And
yeah,
it all goes to the goal of the funds.
Yeah, a lot of options-based ETFs have a lot of, especially in a bad year, there's a lot of rock. Sometimes it's all rock. So people think, what the heck is this? It's all, no, it's just the option premiums being transformed into rock as a tax classification. But anyway, back to YieldMax. You guys have 18 now. As far last time I checked, about 18 of them.
Yes.
Well, I mean, and I should have opened the prospectuses, but you have a lot more that are, being reviewed, I guess, by the SEC. You mentioned Zoom. I think I remember.
So coming up in this, there are some good ones that they're considering coming up. So they mentioned Zoom. I'm not too thrilled about Zoom, but they mentioned a possible Bitcoin one. They have mentioned, which we will get to all of these. And we're going to talk about NAV erosion and reverse splits as well, because that's come up a lot. A leveraged ETF, that one's going to be exciting, right? We're going to talk there in this interview. They talk about Defiance as well.
I remember seeing Airbnb, PayPal. No, PayPal is already out, but there's maybe 10 more coming out. And there's even, you mentioned GDX. How come the ETF ones are taking so long? You got there's the gold one, the biotech one.
I've wondered the same thing.
And what was the other OARC you have already? It was the second.
So like for YMAX took like 6 months.
In one. There was a fourth ETF. I can't remember which one.
I think TLT, right?
TLT, yes.
The underlying one, right? So look, those are all. I'll be 100%.
TLT. Some of you all, that's like your favorite one.
Honest. They're business decisions on where we think there's interest. An ETF is in itself. You want it to be successful. You need to gather assets so that it can self-sustain, right? Where the fees that are generated on the ETF can offset the cost to run the ETF. What a lot of folks don't know, and maybe this is a little too inside baseball, it can cost $250,000 a year to run an ETF, just the fees associated with executing and operating it, right? Even more depending on certain circumstances. So, when you think about,
I do apologize for any background noise. I'm doing the best I can here.
That you have to make a decision on, hey, is the market interested in this particular ETF? And that's why we went live with, some very popular names out of the gate, like Tesla and ARK, of course, at the time was still very popular, still is, Apple, most widely held stock, like, great. So there's a business decision associated with that. When it comes to the gold miners or even TLT, for example, TLT, there's an existing kind of covered call ETF. And we're not saying we'll never do one, but there's one out there, right? It's already kind of satisfying an investor need.
Yeah.
While we think the YieldMax approach might be better, in certain circumstances, there are other opportunities, right? I think there's a GLD might have a covered call strategy. Now, for us with the gold miners, there's always a little maneuvering here when it comes to the way you name things, but basically we need to do kind of a little refiling, a little press conference or a little press release. But I do see that as one of the sooner scheduled launches for the gold miner YieldMax version.
He expects
I think that's probably in the queue.
Listen
I
up.
mentioned Zoom. That's one that's a popular stock, although it has lost some popularity lately, but it's volatile. And so again, the other thing that matters is what? Our yield. It's YieldMax. Yeah. I mean, Berkshire Hathaway was one of the first stocks that we filed for and got approval for. We even have accounts open to trade it, but there's no real benefit yet. There's no juice, right? There's like a 5% yield to do a YieldMax on Berkshire. So until that changes, we don't know if we're actually putting out a product anybody is looking for right now.
Yeah,
right?
You're right for sure, because there's a Canadian company called Purpose that's doing, and they have Burke, and it's their least popular one. So you're absolutely right.
They went live. That's the one that had the most seed money too, right? It started out with the most, and then it grew the least. So, we're just cognizant of what the investors are looking for. So the same reason why we fast tracked YMAX, because it was being asked for by investors. Some of the other ones are less requested. So I would say those are the universe of single ticker bullish covered call strategies. There are other strategies that we have filed for, along with the YMAX. There was a YMAG, which is a Magnificent Seven.
Yes.
That one is effective, which means I could talk about it, and it's gone through the SEC review time period. But maybe
this interview must have been some time ago, because YMAG is already out.
That's one that we go live with shortly, which is just the Magnificent Seven, which we know is, see if I can rattle them off fast, right? Apple, Google, Facebook, Amazon, Tesla, Nvidia, and who's the one that I'm missing there? I'm missing
one. Amazon?
Maybe I did.
Anyway,
Amazon
yeah.
Meta.
Real question is, will the YieldMax funds returns be magnificent like the Magnificent Seven? That's the real question.
Well, yeah. Oh, Microsoft.
Right.
Yeah. So those, right. So that'll just be a YieldMax for the Magnificent Seven. So same thing, equal weighted, just like YMAX. It'll be YMAG. So again, it looks like there's some demand for that. So maybe that's something we see shortly. The other thing that we've, you're right. I don't want this to be a commercial. I want to make sure we're answering all of your questions. But we have some other innovative strategies that have been filed for. We have inverses that have been filed for. We have a version where we are not constrained by a particular ticker, where we can build a basket.
Inverse YieldMax ETFs. Everyone, listen up on that. Inverse YieldMax ETFs.
Any 20 stocks that we want that happen to have high volatility, right? There's a version of that that's coming as well. The ticker for that is ULTI. It's YieldMax Ultra. So, all of those things are kind of coming down the pipe. We are not sitting on our laurels. We want to continue to innovate and give, put out interesting products.
Okay. So is it safe to say that even though you'll see some ETFs and tickers in prospectuses, not all of them are actually going to come out? Is it safe to say that you're really doing out based on demand and feasibility?
Yeah, I think so. Right now, even the SEC would argue, like, why would you put out a fund that has no interest, right? So, but we will kind of continue to assess that. Will we absolutely do every single stock, everything we filed for? Probably not, right? I can't.
Okay.
It's probably more than most, not all.
Okay, so YMAG, by the way. So YMAG has all the, 7, which is kind of already in YMAX. So when YMAG, the Magnificent 7 one comes out, are you going to be adding that to YMAX or no? Or these are
YMAX will not hold YMAG. Right, they will be. Okay. They'll hold the same. Those 7 will be in.
They're already in there. Yeah.
We should know.
YMAX will not hold YMAX.
Separate.
What if you have, like you mentioned, some newer inverse stuff? Will that be added to YMAX or same thing? No, you get it separately.
Those are separate because YMAX is the prospectus talks about covered call, meaning bullish base. So an inverse doesn't qualify. But maybe at some point, if we have enough of the inverses, we put out a YMIN. I don't know, like I don't know, the opposite or something.
I think they're talking about an inverse fund for the YMAG. We'll see if that's he's saying basically why they can't do it.
But today we'll see what the appetite is for the inverse versions.
You're kind of blowing my mind. I'm very excited to see all this stuff come out. I mean,
he's way over a lot of our heads.
Thank you.
Why not? Why not do the inverse, and which I'm assuming is going to be puts, or I don't know if you can talk about it yet.
That's right. So again, this is something that's been filed, so not 100% effective. But what the prospectus says is it will be the inverse of what the YMAX looks like. So we will be long a put, short a call, so a synthetic short. Now, because you're short a call, you have to buy another calls for margin reasons. So you're not naked a call. Nobody wants to be naked anything, right? So we're not naked a calls. So it's a synthetic short, and then sell an out of the money put, which is below the price of the market, right? So maybe you're selling 5-6% out of the money puts, just like how we sell 5-6-7% out of the money calls on the traditional YMAX.
That's awesome.
Yeah, it'll be a fun construction.
Yeah, that's cool. A lot of people.
That's a big point. Okay, so he's talking about the opposite. He's talking about the put side instead of the call side, what they do now for the inverse funds.
I'm going to be happy because a lot of my audience members ask me, so many call ones. Where are the put ones? Well, hey, some put ones are coming, and
there you go.
Let's.
I don't know a lot.
He's getting ready to put out the put ones.
Strategies out there that lets you be, inverse and then have, this high end dividend, right? I mean, I think that'll be interesting, and I'm particularly excited about that one because I don't think there's anything that exists like it today.
Same here. I mean, it's incredible. Not much. Even on the Canadian side, there's a few, but you could count on one hand put ones. So yeah, it'll be fun to see. Let's talk about a question that you probably get a billion times. You talked about it in that Q&A that we talked about earlier. That NAV.
Listen up, everyone. This is NAV erosion and reverse splits. This is what everyone wants to hear, right?
Erosion. So we'll stick with Tesla.
Or we'll see if the answer really is what everybody wants to hear.
The Tesla one, for example, right? It will follow what Tesla does, and you're paying out all the income. So obviously over time, and this is what I explain over and over with these really high yielding funds, you got to expect varying distributions and most probably slightly reduced distributions over time in stock price. What would you do in case it just goes too low? A lot of my audience members, they keep asking me, like, they see a downward trend. Is it just going to go to zero? Would you consider a reverse split or something like that? What would you say to that? Probably number one concern you get.
All right, so the split, the 5-letter word, right? Split is certainly a topic that comes up from time to time. Mm-hmm. So it is something that we look at. I think, look, by the way, ETFs do reverse splits all the time. Typically the leveraged ETFs do this, and that's because they have what I would actually call NAV erosion. I actually wouldn't consider what we experience in YieldMax as erosion. It is the common term that everybody uses.
I knew he was going to say that because the way his frame of mind is that this is not principal. It's just all like yield or like future yield paying up. He's given similar answers in my interviews with him.
So, I'll allow it, like you care what I say. But I think that it's one of those terms that this is the function of the high yield and the covered call tactic, right? Where you take all the downside and only some of the upside, all the downside, some of the upside, and then you get paid for that, that dynamic. So to your question about split, though, it's certainly something that we know that we need to be on the lookout for. We don't want the stock, the ETF price to drop to $5, $2, $3, $1. Like that's just, it makes it difficult to operate. And for a lot of reasons, you lose things like margin on it, and people start to lose confidence on it. So from a tradability perspective, I think it's probably fair to expect that some of the YieldMax ETFs will have a split. So what does that mean? A reverse split, right? So let's say, Tesla's at, Tesla is at $9 and we do a 1-for-2 split. You would double your shares. You would lose half your shares, but we would double the price. So if you had 30 shares, you would now have 15 shares, but at twice the price. And so what's really important to realize is your portfolio position doesn't change, right? Yeah. It's just a swap. Hey, I used to have, 5 singles. So I had 5 bills in my hand worth $5. Now I'm giving you a 5 and you have 1 bill, but it's worth $5. Like that's the idea behind a reverse split. Tactically, it's one of those things that we will definitely notify the community. We will do I think we have a 10-day minimum notification when something like that is going to come up. So we'll make sure we notify the
10 days. I feel like most people find out when they see it happen in their brokerage account.
Investment community that this type of thing has happened. There'll be a lot of FAQs associated with it. So it is something that you're right, just because of the dynamic of some of the price movement of the underlyings, you're going to have a decline in NAV because you're paying out so much in yield. Plus, you get that whipsaw with some tickers like Tesla.
Yeah, it's important. You nailed it on the head when you say your account value is going to stay the same. This is why I don't understand when there's always a freak out when there's either a reverse split or a normal split. It doesn't really mean anything. Your account value stays the same. So it's important that people understand that it really, in the end, doesn't really mean anything. It's not a positive thing, not a negative thing, in my opinion. I'm just saying account value stays the same. Whether you have 5 $1 bills or a $5 bill, it's the same thing. So
and the yield won't change either, right? You'll still get the same percentage, right? And that scenario where let's say you're going to get 50 cents in a single month for Tesla, well, at a 2-for-1 reversal, then you should get $1, right, in your dividend, right? But it'll be the same percentage that gets distributed.
Okay, so just to wrap up the YieldMax.
Interesting. So, like he just said, you're not losing.
I just feel like I'm being pulled in a bunch of different directions, and I'm not sure that I'm making the right.
All right, sorry
so
about
YieldMax, we still have to talk about the Defiance.
So that was a key point there. They just said there's no actual value lost. I personally still, with individual stocks, I'm not a fan of reverse splits, but you see the answer he just gave there.
Ones which I have a lot of personally. What is, have you thought of doing a covered call on Bitcoin? Now we got Bitcoin ETFs. Is there YieldMax Bitcoin coming out? I know you can't talk about it, you guys. Have you gotten interest on that? I'm sure you have, right?
We definitely have had requests and interest on it. It is definitely something that is of top of mind for us. So I think, to be continued on that one, but it fits into the universe of things that we're doing in YieldMax, where you take popular underlying assets or tickers, right? You can generate an amount of yield and there's options markets on it. It fits into all of the things that we would consider when selecting kind of an underlying to run a YieldMax strategy.
Glad to hear that. Last question. In Canada, we have a lot of these. There's leveraged ETFs, like 25%. Typically, what they do is they just hold 120.
So keep in mind, Adrian here from Passive Earnings or Passive Income, he's in Canada, so they've got a little bit different structure in Canada.
25% of the underlying ETF. So would you guys consider like a leveraged YMAX where you guys handle the leverage? And I know we talked about this before and you're like, well, we prefer that you do your own leverage, but I have to say on behalf of myself and the community, we are extremely, because you take requests seriously, extremely interested in that. And I will tell you, I will make the promise to you right now live. If a leveraged version of YMAX comes out, even if it's like a 10% or a 25% leverage, I will invest personally 100,000 in it.
Wow, that's good enough reason for us to do one.
I'm trying to motivate. So within the next year and a half.
I wouldn't say I would invest 100,000 in it, but I would invest maybe 10,000. We'll see.
Because I'm,
All right, yeah. So today Yeah, so look, I'm with you as an options guy. I love using the dynamics associated with options. Leverage is a very easy thing to implement within the YieldMax structure, right? It's like, hey, do a few extra contracts and you're creating notional leverage naturally, right? But today, there is no, I would tell you that it's not something that we are considering at this point, only because we understand the dynamics of leverage. It's not a no forever. It's just a not now.
Okay, I'm still hopeful.
Yeah, and look, this is great. That was completely unplanned, what you just threw out there. This is one of those things I bring back to the partners in YieldMax, and we talk about it.
My reason.
I will tell you when he interviews, because I know this from experience. I've interviewed him 3 times. I don't send him any of the questions in advance. It's not like a political debate where they send out the questions in advance. I don't send him anything in advance. Everything is completely like off the cuff, completely like cold turkey, and he's really good at answering.
Reasoning behind it is because I'm a long-term buy and hold investor. When I buy something, I want to hold it forever. So why not have a leverage and a bit more of a boost? It's just the way I look at it. So thanks for answering all those questions.
Yeah, you're welcome.
Max, sorry, go ahead.
No, I was just saying, look, the yield is going to get leveraged too in that scenario, right?
I mean, can you imagine? I mean, it's mind-blowing to me. I mean, what are we going to have on YMAX? I mean, YMAX, I'm assuming, the first distribution hasn't been declared, but it's really an aggregate of all the, I did it actually all myself.
Dang, I'm wanting to buy into YMAX now. They're thinking it's going to be like a smashing dividend, which usually I notice the first ones tend to be.
Out of all the yields, I got to about like 40 or 50 or something. It was really high because a lot of these like Connie and the AI one and Square, these are rocket yields. But then you have like the Microsoft, JP Morgan, ExxonMobil.
Any laughter you hear in the back, it's because the other people in the house are starting to realize how big the dividends might be.
Which are a lot lower, but the average was still like 45 or 50. So imagine a little bit more, like we're talking like crazy yield. It just blows my mind. So anyway, super interesting stuff. Moving on to Defiance, you guys also manage the Defiance ETFs or the option.
This is going to be a good one, Defiance. So keep in mind, like he just said, Jay also, him and his team also are involved with Defiance.
Advisors. I'm talking about QQQY, JPY, the Russell one as well, IWMY. I always
IWMY.
Yep. Okay, so in the Q&A you did, and maybe you could just confirm this real quick. I don't want to talk about it because you already talked about it. How really the Defiance ETFs are kind of the same as the YieldMax ETFs. And I was so happy to hear you say that because that's what I feel. In the money put is really the same kind of thing as an out of the money call. Can you just confirm that, how really the Defiance ETFs are pretty much the same, except instead of a single ticker on ETF, you're doing it on the index?
The index.
So I will confirm the structure of an in the money put
is
the same option structure as a covered call at the same strike or a synthetic call at the same strike. The P&L chart looks the same.
You all hear that? Shoot, I think I just clicked off of it. Darn it. Anyway, while that's buffering or whatever it's doing, shoot. I just accidentally clicked off the darn video. Bear with me here. Maybe we'll do some comments real quick. Yeah, I'm responding to some of you all's comments as I go here. Darn it, I just clicked off the freaking thing. Sorry about that, guys. Where is it now? Okay, I just want to go back to it. Bear with me. Okay, we were at about 27 minutes in. Okay, and yeah, just read the comments. I'm responding to all of you all's comments. Okay. Bear with me, I'm going to get the screen share going again. Right. Right. Well, we got 31 of you on. That's cool. This is like the intermission, so to speak. So grab a beer if you need it. Okay. Here we go. Now we are.
Hear you say that because that's what I feel. In the money put is really the same kind of thing as an out of the money call. Can you just confirm that?
That was what it was so profound. I wanted to make sure everybody got that, and I clicked off the video. And in the money put is the same as the call.
Really, the Defiance ETFs are pretty much the same, except instead of a single ticker on ETF, you're doing it on the index.
Yes. So I will confirm the structure of an in the money put is the same option structure as a covered call at the same strike or a synthetic call at the same strike. The P&L chart looks the same. The hockey stick looks the same, right? Because it's, you've got the up movement and then it flattens at the strike.
Yeah.
It's the exact same look of an in the money put. A lot of folks think, puts, oh, you're supposed to sell out of the money puts because you're like selling as a limit order, and as it goes down, you could get assigned. That's true. That is a more popular tactic to use with puts, or if you're hedging, you buy an out of the money put. But a lot of folks have missed the fact that an in the money put replicates a covered call. It's actually, I can use a term that, maybe it doesn't apply all the time, but I actually think it's a much more elegant solution.
And in the money put replicates a covered call. Remember that.
To the covered call, the synthetic call. Now, there's a few things about that. The first thing is, with Defiance, we are selling options daily on an index, and those options are cash settled. So there's a little difference of the underlying between an equity option and an index option. They are treated a little differently. European style versus American style. That has nothing to do geographically. It's just whether you could be assigned early or only assigned at expiration. So all of those things together, while it is true that it replicates the covered call strategy, there are some other pieces like doing it on indexes that actually even make it more advantageous to do the in the money put.
Yeah, I absolutely, and I made like 1 or 2 or 3 videos. Even so, we're filming this, by the way, on the 23rd. It's gonna come out Sunday, but Saturday I have a video where I say why I
10 days ago.
went all in with the Defiance ones instead of the YieldMax, and I really love the option strategy better because it's a daily. So there's less of a chance, instead of doing a weekly or a monthly like the YieldMax. Not only that, but I also like that it's on indexes. Who doesn't love the S&P and the NASDAQ indexes, right? Really awesome.
Or even the Russell.
I really love those strategies. So thanks for confirming that. And by the way, this was actually a member question. Are you doing always 1 day options? Would you do 7 days as well on the Defiance, or is it a mix of the two? But it's primarily a 1 day option. So what's the can you go into details of the option strategy, the time frame?
Sure. So the prospectus gives us the ability to do 1 week or less.
1 week or less. Okay.
1 week or less. But we generally, and by generally, I mean nowadays, and I'll explain why I say that, generally do 1 day till expiration. And the reason we do that is the way that time decay works is it's maximized, especially with the money options, which is kind of what we're doing here, those slightly in the money options, I would say generally are at the money. Those options have the most rapid amount of time decay. So in other words, if I did a 3-day option versus a 1 day option, I might be able to sell for 25 basis points 3 days in a row.
For your question, Gypsia, I'll get to that at the end. That's a very good question. That might actually be a separate video.
Versus a 3-day option with those 75 bips. That 3-day option, I might only get 50 bips, 45 bips, right? I might not be able to get all of that time decay. And again, the primary goal of these is income, right? Income is the primary goal of these. And so if I can do 3 1-day trades and get paid more than doing 1 3-day trade, I'm going to do the 3 1-day trades. Now, why did I say in general? So there are times up until now, there weren't daily expirations on the NASDAQ and the Russell. The S&Ps had daily expirations, PM settled daily expirations since back to July of 2022. But the NASDAQ didn't put out daily options until October of 22, but they still don't have a PM settled option on the monthly. So remember the old school options, hey, once a month, third Friday, the AM settled. That is still the only option that exists on that Friday. We just had one on January 19th. So in those scenarios, I don't want to sell an option on Thursday, the 18th, that expires the morning of the 19th. So in those scenarios, I will go to Monday, right? So in that time, I'll go like 2 full days. Same thing for the Russell. The Russell just went live with dailies. They only had Monday, Wednesday, Fridays up until really just last week. I think we had something to do with that because we're familiar with the product managers. We said, look, we really want to have dailies. We were probably just the excuse they wanted to push us over the edge. I know the product manager always wanted it, but now same thing with the NASDAQ. Every day except the option, except the monthly option has a PM settled. So when it comes to the third Friday or the third Thursday, it might not be the third Thursday, you'll then see us do a 2-day trade. So let's say 19 out of 20 times we expect to do a 1-day trade. Okay. There's at least 1 day a month that we'll do a 2-day trade. But in general, we know that you get more rapid time decay doing a daily option.
Yeah, and okay, so a lot to unpack there. A lot very technical. Can you say when you say time decay, you're trying to capture more time decay? It's kind of like saying you're trying to capture more premium.
Oh yes, sorry. Right? So yes,
you're trying to get more income, more premium, right? Because I love the example you gave. If a 3-day gives you 45 bips, but a daily gives you 25, which is 75 total, you're gonna go for the daily one. So that kind of explained that's how I understood it. So generally, most of the time, as much as you can, you're gonna do the daily, but sometimes, for whatever reason, you'll do maybe a 2 or 3 day one or something like that if you have to. But there's another question I got that could be related about the distributions going down, which we'll talk about it. Do you feel like there's enough?
Okay, so this is probably the most key point of the interview, talking about distributions going down. This is what we all want to hear.
Of options market on these dailies on the S&P, the Russell, and the Nasdaq, or is it getting like oversaturated? What's your opinion on that?
Yeah. Okay. So two things. So, by the way, apologies for getting really technical in the
No,
daily
it's okay.
stuff. When it comes to the lower distributions, this is absolutely a function of volatility in the marketplace, right?
That's what I
When we
thought.
launched the Defiance funds, the first two in late September, guess what? The market had a higher implied volatility, right? The VIX was higher.
Yes.
The market was a little dicier, a little scarier. So you could sell options for more each day because there was a more implied move. Like there was, hey, maybe we're going to move 2% today, 1.5% today. Whereas today, with a VIX of I think 13, it's got a 13 handle, right? So with a VIX of a 13 or 12, you can't get as much premium on the options that you sell each day, with the exception of, I'll give you an example, like before a Fed day, right? We'll see option, premiums jump. Before a jobs number, right? We'll see option premium jump. But, this week, we're kind of running smooth, volatility's on the low end. Those options we'll sell for less time value. And again, the goal of these is to distribute the time value we earn, the extrinsic value we earn, the option premium we earn in those in the money puts. And so if there's less volatility, you're going to have a lower dividend. So that's really the answer.
It's not a
So that's a really key point that he just clarified there. So talking about lower distributions, it's basically all a function of the implied volatility that we're dealing with in the market. So the higher, the better dividends we have, the lower the dividends we have. That's a really key point he just cleared up there.
about that there's an oversaturation, there's a problem with the strategy, this and that. It's 100% based on volatility, right? Because this is a main concern that I've been getting. Obviously,
Yeah,
it's a legit concern. You see a dollar, QQQY, let me just bring it up here real quick. $1.10, then $1, then 93 cents, now 62 cents. And JPY, the S&P.
He's going over how the dividends dropped. This is really good stuff, guys.
90 cents, 91 cents, 65, then 50. And I was actually curious about that. So I actually brought up the VIX chart, and I saw that, even 3-4 months ago, the VIX was like double. It was like,
It'd be nice to overlay the VIX chart with what we're talking about.
You got it.
It was like 20 or 21, and now it's like so low because the market's been really boring. So it's not a, can you just reconfirm again? It's not a function of problem with the strategy, problem with the fund, problem with the options, not enough options, not enough whatever. It's purely just volatility, and it's 100% normal.
Yes. So I will confirm that we are not influencing the premium of the S&P or NASDAQ or Russell options. Certainly not at these
They're not influencing the premium. Darn.
sizes. I think you could add 3 zeros to the end of our AUM and we still wouldn't impact it. Those are huge option markets. And how do I know this, right? Let's take.
So what he's saying is that they're not a market mover.
A strategy you've talked about before, JEPI or QYLD, right? Kind of the OG covered call ETFs, right? They do like a $5 billion trade once a month. You don't even see a blip in the NASDAQ, right? JEPI's 30 billion in size.
30 billion.
I know they have multiple tranches. They don't impact the market, right? When they do their roles. So it's one of those things that it's not just because I think it's because when I look at what else is out there on funds that are, literally 100 times larger than ours, they're not moving the market in the exact same, indices that we're trading.
Wow, that gives me a lot of confidence. I'm sure people watching. I never had that worry because it's the S&P 500, it's the Nasdaq 100. It's like, it's not like a single stock. It's like the whole world. I doubt you'll ever have a liquidity problem. I guess people are worried about a liquidity options problem or something like that, but you just confirmed it by saying what you did. So I really
I'll add one other thing, right? We go to multiple market makers when we do these fills, right? So we don't go to a single source. We trade directly to the street with some of the biggest names. And they are, absolutely, but they're all filling at very, very similar prices, right? It's not like, oh, this one guy's, always lagging, or this one's really opportunistic. They're all coming in very, very similar, which tells me it's a stable market.
Okay, perfect. Thanks. I'm just looking through my notes, making sure I don't forget anything, but you pretty much answered everything. The Defiance, the main thing was to confirm in the money puts and out of money calls about the same thing. And the biggest concern or feedback I got, the lowering of distributions. And like I suspected, it has all to do with volatility. By the way, the VIX, I know that's S&P 500. Just a personal question for me. What about the NASDAQ? Is that also influenced by the VIX, or is there like another NASDAQ VIX, or it's the same thing?
There is. It's VXN.
VXN, okay.
VXN is for the NASDAQ. And then the Russell, it's RVX.
Just learn something. There's different. So there's the VIX, there's the VXN, and then I want to say the RVN for the Russell. RVX, VIX, VXN, and RVX for the Russell.
So they all have their own volatility indexes, but it's a function. A lot of charting tools will also show you the implied volatility of the options. The one thing I would say about those indices is they are 30-day VIXs, right? Which means they look at from 0 to 40.
I want to say VIX is S&P. The second one we mentioned was NASDAQ. VXN is NASDAQ, and then RVX is Russell 2000. That's good to know.
Usually, and they say, okay, let's aggregate all of the options in this range. And that was done when there were only monthly options, right? Now we have daily options. There are VIXs with much lower time frames, right? A 9-day VIX, you can take a look at those. Those will even be more correlated to the distribution rate for the Defiance funds.
Yeah, I see a bunch of smaller channels trying to predict the dividends. I'm like, why are you even doing that? But anyway, it's fun. There's a lot of speculation with these funds, even though it's like kind of a boring fund if you think about it. QQQY, I keep saying it's kind of the same thing as a JEPQ, and JPY is kind of the same thing as a JEPI or a SPY. I mean, the underlying the same. It's not, people say it's so much more risky than a JEPI. It's not. It's just different.
It's not more risky.
So are we all convinced yet that we're going to get rich from these investments now? Do we all feel better?
Right. It's just the structure is more simple, right?
Yeah.
The cash settled. All we're doing is taking index risk. It's not leverage.
I love the daily because it's daily. I really like that. I find it's a superior option strategy. You kind of admitted, you said it a few times yourself here in this Q&A. So just real quick, distribution policy, same as the YieldMax kind of, you're giving out all the income.
Yep. The goal on those is we're giving out what I would call the extrinsic. So there's a little difference with an in the money put, right? There's an in the money put. There's two parts, right? You've got your extrinsic part and then your in the money part. Actually, I go the other way. So the in the money part is the price of the index to the strike price. That's just whatever the underlying index moves, we'll capture that. Yeah. The extrinsic is the, the implied volatility, the time juice, but really they're both in the premium. So we don't distribute all the premium. We actually calculate of the option. Like let's say an option was 0.5% in the money and we, sold that for 40 basis points. In that scenario, and let's say it expired worthless, right? We earn all 40 basis points. We're only going to distribute the 15, right? 40 minus 25, only going to distribute the 15 of time value, the extrinsic value. That will be the dividend. We're going to hold as long as we can that in the money. I'm going to call it the underlying index movement as long as we can. At the end of the year, if that is net positive, we'll distribute that as well. But up until we approach the end of year, the end of tax year for the funds, and those are not always the calendar years, it might be October. Up until that point, we're only going to distribute what we earned in the extrinsic sale. So for you options geeks out there, right, there's intrinsic and extrinsic. The extrinsic is what I would call it. We always refer to as the time value. It's the same thing as what the in the money call amount would be if you just sold the call. The upside capture is what that in the money portion is.
Yeah, so I understand. Let me try to translate it in case people don't understand it. What you're distributing is the money you're making off the premiums. It's the premiums. It's not, let's say the NASDAQ goes up or the S&P 500 goes up. You're not distributing that part, the part of the index is going up. You're keeping that in the fund. That's why you see JEPI go up and QQQY go up when the NASDAQ or the S&P 500 goes up. You're giving out just the option premiums, kind of the time decay.
The time portion of the premium. You're right. Okay. Because there's two parts of the premium in that scenario.
Yeah, it's a little bit more complicated with the Defiance ones to explain. It is. Because but I kind of like the YieldMax. You're giving out just the time decay or the premium. So, oh yeah, and by the way, maybe I'll have to tell Sylvia about this, but I am also extremely interested in a leveraged QQQY and JPY. And if one does come out, I'm switching to the leverage one right away. You have my promise on that. And I have about 200K of my own money in these. So it's a significant portion of my
thank you. That's great. That's
personal portfolio. I have it on drip.
That's a lot.
And I'm kind of showing people how what you actually confirmed on that other video. It's all about you're overthinking the QQQY and JPY, in my opinion. You're looking at the stock price and the decay of that. But I invested 100K in JPY and I put it all on drip. Now my investment's worth 110. I put 120 in QQQY and now or maybe it's the opposite. And now it's $10,000 more. So like you keep saying, it's all about portfolio value. And if you want to maintain that, you've got to reinvest your dividends or a portion of it. My argument, and I made a recent video about this that kind of took off. These are not really the best funds to extract everything to live off of to pay your mortgage. You talked about that, right? Like don't take everything out of Tesla and QQQY and pay your mortgage. You can do that, but it's kind of like selling off your investment. So hopefully I try to show with my example that if you do reinvest everything, your investment goes up, your account value goes up. Any final thoughts on that? Because I know you explained it a billion times already.
Yeah, you got it, right? So it's maintained. That's the allocation. Otherwise, you're right. You're just converting your position to cash if you don't reinvest it. Yes. The other thing I would say is your dividend now, because you have more shares, right? Not only do you have more value, you also have more shares. And so because the funds have appreciated on a total return basis because the market has moved up. So not only are you getting the high yield and you're compounding those, the value of your shares is probably also, things are appreciating in the total return aspect. That's why your position now is 110 when you started 100. Your dividend will also then go up based on the number of shares you have, but your rate, is still based off that higher balance. And so by maintaining the position balance, you get the rate you want. So even though I should have looked, let me look for 2 seconds here. I'm just going to pull up the price of QQQY, right? It's $17.90 right now, right? We launched it at $20. When we have, a distribution, even though it might be lower from you quoted the cents per share, that might be lower. It's a higher percentage and you have more shares and you have a bigger balance. So the yield will be more maintained that way, but it's all linked together. It's why drip matters.
Exactly. Does
everybody get that about drip? So the share price drops, you have more shares, you're getting dividends on more shares, so you come out ahead in the long run.
Oh, exactly. I invested in both of them. I
feel like you just can't really use these for income. You have to reinvest the dividends back into them.
$20 a share. Now they're at 18, but my investment is higher. How do you figure that, right? So that's why I keep saying or keep telling people it's really about that dividend or that income. Don't just spend it all. That's part of your investment. If you want to live off this stuff, you can, but you kind of got to do a little bit extra portfolio management. But I'm just going to turn the drip on, let it go. My plan, let it go for at least 10 years. And maybe it'll be $15 or $12 or $10, but I'll probably have thousands and thousands of units. So that's what maintains the value, makes it go up. So I totally get it. I could only show my example and I unveil my portfolio every month. So
that's great that you do that. And you can, show people by example versus people theoretically,
it's harder talking about it because I tried many, like you have, but I feel it's easier just showing my portfolio every month and say, look, every month. And
we'll start doing that more and more on this channel too.
Then it starts clicking because it's not exactly the easiest thing to understand. It takes time and experience, but as an income investor, I get it. So
it's true. Like, well, even though the strategies are in an easy to purchase wrapper, like an ETF build, there's still an options tactic underneath, right?
Yeah.
So you still, if you're going to buy these, you should have a little bit of an understanding of what the money put or the out of the money synthetic call is doing to understand how to properly use them. And look, I get it that we could be accused of taking a complicated strategy and making it too easy for the average investor to buy. But my counter argument is, yeah, but we've made it really easy for people to now get access to a strategy they didn't really have before. So the active management, the zero DTE options, like this is all pretty innovative stuff. We're really happy to bring it to the market.
Agreed.
Yeah, and you could do all this stuff on your own, right? Whether it's selling calls on Tesla, whether it's doing the daily, but
Sure.
that is why you're paying the management fee, which is, I find it's not super exuberant. Obviously, it's going to be much higher than a passive index ETF. They don't do any work. There's a lot of management. I mean, you're doing this daily, you're checking the days. It just drives me crazy thinking about doing it myself. Happy to pay the fee and let the pros do it. That is really the point of these ETFs. It's another argument I hear about the management fee. Yeah, well, it's a lot of work to do. So Jay, keep up the good fight, man. You're going on all kinds of channels. You're repeating the same stuff, and I like that. I feel like we have a good rapport, and you're trustworthy because you're kind of always saying the same thing, which is good because you're
not mixing the message up a little bit. You're right.
So,
but
no, he's
in
on
all fairness, right, to your
Great.
audience, you know this. You were the first, right? You're the first that came to us and said we really want to talk about this. So thank you for your ongoing support. And yeah, I've always enjoyed our discussions here. So thank you.
Yeah, I appreciate it. We'll have you back for sure. It was nice talking. Thanks for taking the time. I know you had a meeting, you delayed it, but you're awesome in that. And again, no script, nothing. I'm going to publish this Q&A as it is, and I'm sure the audience will.
All right, so that was a really great interview. We'll do some comments here, but yeah, he's like he said, he's on message. He really doesn't deviate from what he says. He's a great person to interview. He's got lots of good points, and every time I listen to him, I always feel better about these investments. So let's see here. I guess we'll go in reverse order here. Last comment first. He has close to 75,000 subscribers. The fund managers book interviews with him all the time because of his audience reach. He did a few interviews on Simplify. Well, I'm just honored that he comes on to mine. He's been on to mine 3 times. He did make me wait, though, because I know he had some bigger ones booked. Let's see. You guys are right. Should be a lifelong learning. Great information. A lot of opportunities coming. It is important to learn as much as you can about the investments you make. Can't stress that enough. 100% agree. And Jay always says that himself. We're not going to read every comment. We'll just do a couple of them here. Okay, I think Gypsia got questions answered here by Charles. Implied volatility is like steroid pump for options. 100% agreed. That happens a lot before earnings too. Covered calls are sold, higher pump, higher premium sold, higher monthly distributions. Thanks for trying. Some things I don't think I'll ever get. Watch a few videos. We'll talk about all that more. Just stick with us. Much of the lure of the option strategy ETFs is that you don't have to worry about how the sausage is made. Never let learning get in the way of you making more money. 100% agree. Okay, so let's see here. The question that Gypsia asked, what percentage of our dividend do we need to put back into a fund to keep our capital? That probably varies. They got to some of that. He didn't say all of it, but I probably see. We'll have to get more case study data on this. Hopefully, my Schwab account will be stable and I can just start showing it. Hopefully, Hopefully, it doesn't move around again or get sold to another brokerage firm, and then I can show month by month, the dividend journey. Right now, we're at like 60,000 a year in dividend income. So hopefully, that will increase, and we'll find out exactly. The answer will come over time, I think. But anyway, thank you all for tuning in. That was a great interview. Glad I could do a reaction to it. And by the way, he will be back here, I want to say, next month. We're supposed to have him back on. So like, comment, and subscribe if you haven't already. And we will see you all very soon. Take care.